Yes, namaste, a very good evening. It is my privilege to welcome you all to this today's study circle meeting on year-end compliance under GST and Income Tax Act. I request our chairperson CA Kavita Parmes to kindly escort the speaker on to dais and welcome him with the knowledge book. Thank you, Chairperson. Dear members, now I request our Chairperson CA Kavita Parmes to give a welcome address.
Thank you, Vinod. A warm welcome to each one of you for this study circle meeting on year-end compliance. Most importantly to the speaker Hanish, thank you for being here. A warm welcome to you. So this is part 2 of the series 2 of the year-end compliances. We started this where whatever compliance are the various statutes which are having an implication on the book closure. So today we have this GST and Hanish is here to share his knowledge. Please take advantage. After this, it will be on income tax where Speaker Rani will be addressing us on the income tax compliances. Next week we have the year-end compliances under Companies Act as well as on the CCFS scheme, the amnesty scheme which is being announced by the Ministry of Corporate Affairs. And also most importantly what we thought is in that session what we have also additionally included is the recent judgments under the Companies Act. If you are all noticing, there are ROC, the Register of Companies, they are taking up the cases, reviewing the private companies, the financials or the annual returns which are filed, and based on that the notices are being issued and as orders have also been passed. I could give a simple example. For non-voting the sin in the letterhead, there is a penalty of 7 lakhs which is levied to the company, and the total penalty is 7 lakhs including the company and the directors. So this is a very simple thing for us when we look at it, but then look at the seriousness of the matter or how important the ROC is considering this. So keeping these in mind, we have also included that day one hour session on the recent judgments under the income tax, under the Companies Act also, which will have a bearing on us. So these are the 3 important things which are coming up. Rani, please come over to the stage. Please. She is our next speaker. Welcome to you, Rani. Also, we are one more important thing which I wanted to inform all of you is about the Moot Tribunal program what we have started. This was mainly because we wanted to encourage young and women practitioners to come up and to take up GST or income tax litigation as an area of practice. So where do I go for the training? There were questions when I was discussing with some of the members. Then we thought, okay, why not we create a program in a structured way which will have the training. So the program has 3 parts into it totally. The first part is where we are conducting a training session open for all, which will be on the litigation, legal aspects of it, the theoretical session or classroom session, where the speakers will take you through the basics of the litigation, and that is on April 11th. And post that there will be an assessment test which will be conducted. Based on the assessment people who get through, we are selecting 12 people under income tax and 12 people under GST. Right now we are doing limited because of the mentors, where they will be trained by the mentors. The mentors are the experts from the litigation field, in the litigation field, both in GST and income tax. The details will be displayed little later on the screen. So these mentors will train over a period of 1 month on actual cases. You will be provided with the actual case which has a assessment order and how to prepare and based on that assessment order, how to read the assessment orders, what are the grounds, how to pick up the grounds, and how to represent also will be taught. And then the third part is the actual argument. So we are simulating the tribunal environment, and where we will be having bench members also For income tax, we are looking at the current bench members only, so they are most probably we will have the confirmation in a week's time. So we will have members who will actually be present, and the entire simulated tribunal environment will be there, where you could represent and argue your case. Both department as well as SSC's representation can be possible. So this is something what we thought is will be really useful and good learning exercise for our members. I would request you all to look at the program schedule. The entire details are there, and also spread the word and encourage other people, your friends and other known members, to take up this. With this, I hand over the dash to Vinod, and I welcome Rani NR, who is here. Thank you, who will be addressing us on the income tax matters.
Thank you, Chairperson, for your welcome address. So it is my now I request our Chairperson ma'am to kindly give a book bouquet as a token of gratitude. Thank you, ma'am. Members, it is my privilege to introduce our today's speaker. Hanish. He is a partner at CNK, HSK and Associate LLP and heads the GST litigation practice. The firm is a part of CNK network, having 10 plus offices across Bangalore with a team strength of more than 1,000 people collectively. Hanish has represented clients before various firms including Sestat and Advanced Ruling Authority. He is active speaker on various impactful platforms like ICAI, ICSI, Bombay Chartered Accountant Society, Chamber of Tax Consultant, etc. With this brief introduction, I now hand over the stage to C. Hanish sir to take us through today's insightful session. Over to you, sir. And members, this section will go up to 6:15. At 6:15, we'll have a tea break for 10 minutes, and then next session on income tax will start by C. Rani. Members, it is my privilege to introduce our next speaker, C. Rani NR. He is a fellow member of Institute of Chartered Accountants of India with over 19 years of professional experience. She is a partner at G. Ananta & Co. Bangalore, specializing in statutory and regulatory framework for both non-profit and for-profit sectors. She holds a diploma in international taxation from ICAI and has significant expertise in international taxation and transfer pricing. Rani has authored and co-authored publications in these domains. She also holds a master's degree in business law from the National Law School, Bangalore, and she is a regular speaker at professional forum on income tax and international taxation. With this brief introduction, I present before you Rani NR. Rani sir, over to you.
Good evening, everyone. First of all, I would like to thank the Bangalore branch for inviting me for this program, and also to wishing all the very best to the entire new team. I really like the two new concepts which they have introduced. When Kavita ma'am called, she said that we want to do a program for due dates in all the laws, and that's why we are here for GST as well as income tax. So very nice thought. And second, again, what ma'am mentioned about the tribunal practice, interesting program. I have definitely not enrolled for that program, ma'am, because I will not get shortlisted, I know. Because there is an exam which we have to write, and only then 12 will get shortlisted. I know I will visibly fail in that. So I am not in a position to... No chance, ma'am. Tribunal and GST, nobody can be qualified because everybody has same years of experience. We all started in 2017. Nobody has more experience than that. Right? Okay. So, let's start. Not a very technical topic today. We are only talking about what are the compliances which we are required to do by 31st of March. And while this session is on a little later, maybe a week after 31st of March, and we might have missed on few of these deadlines because few compliance requirements were required to be complied with by 31st of March. We'll look at those. But there are few more which we have time to give effect to while we are filing the GST returns, which are due on 11th of April as well as on 20th of April. Few of the due dates go till September, and then few go up to 30th of November as well. So it's good that we know or we are mindful of what are the compliance requirements from a GST angle. So may not be a very technical topic for discussion today. It will be more of this has to be done, this is good to be done, this may not be done. This is what is going to be. Feel free to ask questions at any point in time. The most questions which I am scared about is a portal is acting this way. So how do we handle it? Those questions I may also not be in a position to handle, because every day when we are coming across newer issues, we are not able to find answers to those. Like recently we came across an issue where there was a crore of rupees assuming of demand, and the appeal was filed within the due date, but the recovery had got initiated of 25 lakhs because in the bank account 25 lakh rupees was there, so 25 lakhs got debited. We've got a favorable order to the extent of 60 lakhs. 40 lakhs is again to be appealed against. When we are filing the appeal, for the 40 lakhs I am required to pay a pre-deposit. I have already paid more than that, but that is going and sitting in admitted liability and not in pre-deposit. So again we'll have to pay pre-deposit. Luckily for that advisory was issued. But in our case, what has happened is, while the advisory is useful, I want to file a refund because I have paid something more than what I am supposed to pay, but the portal is not allowing that refund to be filed at all. And the officer is saying if it is not coming under refund based on an order, I will not be able to process the refund at all. So then we went back to the person who passed the order. He said, I will rectify. She rectified that order, but still that issue is still, we don't know what is the issue within the system, and so we are not able to resolve that. Like that, every day we are finding some or the other new innovative issues which are coming up in the portal. So if there are any issues relating to portal, I'll be happy to note it down, but I may not be in a position to give you a concrete answer for those, because even I am new to all these portal challenges. Like somebody mentioned, there are actually multiple laws in GST. One which is there in the book, one which the officer is following, one which the consultant believes, and fourth is portal. Right? So all are completely different. Right? I have bifurcated the session into three parts: outward supply, inward supply, and RCM. So let's look at first the outward supply. This is going to be a little dry, so to ensure that my interest is maintained, please keep smiling and keep looking at me and responding. So my interest in the session will be maintained, right? Okay. So first we are talking about GSTR 1 versus 3B. All of us are aware that in the portal there is a report which can be generated to compare month-wise how much the tax which has been reported in GSTR 1 versus the tax which has been discharged in GSTR 3B. It has to match. What if it does not match? If it does not match, then we are going to get an automated notice in the form of ASMT 10 to avoid that kind of notice and to avoid any interest and penalty. It is in our interest to ensure that on the portal the mismatch between GSTR 1 and 3B is addressed. Sanjay is here. I can tell, because he's already sent that letter to me. One of the clients which Sanjay and I work with very closely, thanks to Sanjay only, they have an audit, and in that audit a query has been raised that these are the GSTINs where GSTR 1 and 3B is not matching, so we are not giving you credit of these list of suppliers. So the officers have gone to the GSTR 1 and 3B of the suppliers and said in GSTR 1 of this supplier 1 crore has been reported, in 3B 99.5 lakhs has been reported, so they have not discharged the full tax, so we are not going to give you credit. Unfortunately, Sanjay introduced me to that client, and in that list my name is also there, where we have not paid 2,500 rupees, and so the client is being questioned that HSK's invoice credit will not be available. I have still not replied to Sanjay on that. The only thing is, the reason is, there was a credit note which we could not adjust in the month of March of the last year, which got adjusted in the current year, and so there is a reason why there is a shortfall in payment. So reason is there, but there is no place where we can capture this reason, and so there is a notice which is going to be issued. So there are two actions which you can take here: either keep the reason ready, or if the reason is not available, then make good that short payment so that you avoid these notices. So the first step, go back to your portal, check in all the clients whether GSTR 1 versus 3B is matching or not, and if there is mismatch, see if there is a reason why there is a mismatch. Right? Yeah, is the font too small, right? I'm sorry for that. Second is, okay. Now let's go to the second. I'll keep jumping between returns and then go back to job work and then go back to outward supplies, then go back to the concept of supply. All of these I'll keep jumping. Second is, if you're a principal manufacturer, which means you subcontract a portion of your work, in that case you have been sending material to your job worker, you are required to get back that material. If it is raw materials, you are required to get it back within 1 year time, and if it is capital goods, you are required to get it back within 3 years time. You can apply for extension with the principal commissioner, who is the jurisdictional officer for you. If you don't do that, in that case, from the time, assuming 1 year expires, the transaction goes back to the date when you have dispatched the goods, and it will be deemed to be a supply from that date, which means you will have to discharge the tax and interest, and in all likelihood, the job worker will not be able to claim the credit as well, because you will have to date the invoice on the day when you originally sent the goods, and as per 16(4) there is a time limit available, and if the invoice is not within that time limit, the job worker will not be able to claim the credit, so GST will be a cost to you. So here, be mindful of what are the materials which have gone to the job worker and how much of it has been come back, how much of it has come back. One, it has to come back within time, and second, also is there is a return called ITC 04. Okay, if anybody has tried filing ITC 04, even now after 8 years of GST, we are not able to fix that ITC 04. So whatever report you are filing in ITC 04, file it. A lot of data you will not be allowed to capture that in ITC 04. So have a parallel ITC 04 where all the transactions are compiled, because there will be e-way bill where you have sent the goods on job work, there will be e-way bill where you have received the goods from the job worker, and for some reason ITC 04 will not allow you to enter those transactions because it does not understand whether it is last year transaction or next year transaction. It will not allow you to capture and file. So have your own parallel Excel sheet of ITC 04, so in case there is any audit and if there is a requirement, you can produce that and say that ITC 04 which is available online is incomplete, and this is the correct data which I am furnishing to you, which is matching with the details given in the e-way. Third, very often we see that outward supplies are very nicely tagged because everywhere invoice is required to be generated when I give it to my customer. But when it comes to sale of assets, because I have handed it over to my employee, or sale of assets as scrap, I have just given these laptops, 10 laptops I have given, 20 laptops I have given. Whenever there is a disposal of assets or inventory, please ensure that by 31st of March, whatever treatment is required to be given, and we will come to what you mean by whatever treatment. Whatever treatment is required to be given, ensure that that treatment is given. Right? Now what could be that treatment? I have an asset which I have given it to my employee free of cost. Am I required to pay tax on that or not? Unfortunately, section 15, there is an explanation which talks about related party, which says employee and employer are related to each other. How much ever they love or hate each other, for the purpose of GST, they are treated as related parties. Then we come to schedule 1, which says transactions between related parties will be deemed to be a supply even if there is no consideration between the parties who are engaged. So that means how much ever love you have for your employee because of which you have given the laptop to him, or how much ever love the employer has on you, so he has given the laptop free of cost, for the purpose of GST you will have to discharge the tax. Valuation, maybe some other day we can discuss some passing references we can make, but the point is tax is applicable. Okay. Also another point to remember here is, irrespective of your accounting treatment in the books of an asset, that you have a policy that you will write off the laptop within 3 years time. Irrespective of whatever be the accounting policy, or any asset below 10,000 rupees, you will write off the first day itself. Right? For the purpose of GST, all the assets carry a life of 5 years. The moment you have capitalized it once, irrespective of whether you write it off or not, for the purpose of GST, the life is 5 years. Right? Now, assuming we are talking about the same laptop which you have given to a NGO free of cost. They are not at all related parties under section 15. You have given it to NGO after 3 years, because your policy says after 3 years you will discard the laptop. Right? Now you have claimed the input tax rate, assuming the value of the laptop is 1 lakh rupees and you have paid 18,000 rupees as GST, right? For the first 3 years you have used the laptop, right? So 18,000, the total credit was claimed by you on the first day itself. We will take a very simple example so we don't complicate it. We will take the value of GST on the laptop was 50,000 rupees, okay? You have claimed that 50,000 credit on the first day itself, right? On the day when you purchased it, you have claimed the credit of 50,000 rupees, right? You discard it after 3 years, right? So what government is trying to say here is that I have given an asset to you, I have given the credit on the asset to you, assuming you will use it for 5 years. You have used it only for 3 years. For the balance 2 years, you are required to pay the tax in the form of reversal of input tax, right? So I will have to reverse the credit for the next 2 years, which is 50,000 divided by 5 is 10,000 rupees a year. 30,000 you will get the credit because you have used the laptop. 20,000, even if the laptop is of no use, you cannot use it at all, still 20,000 rupees you will have to reverse the input tax to. So now when we are disposing of the asset, you will have to identify whether you have to pay tax on the sale value or you will have to reverse the input tax rate, whichever is higher. Clear? And if you have disposed it of to a related party, you will have to find out the value for that by going to section 15, going to 27, 28, 29, identify a value and discharge tax on the same, right? If you have sold something as scrap, it's really very important. If you sell laptop as a laptop, earlier there were differential rates, so that way earlier it was important. Now may not be because there are not so many rates. Okay? If I sell laptop as a laptop and the rate of tax on laptop is, for assumption, 5%, then you have to pay tax at the rate of 5%. But if you are giving away laptop as scrap and assuming the rate of tax on scrap, because it has plastic, it has metal, all the other things, okay? The rate of tax on scrap is 18%. Please decide, what are you doing? Are you selling scrap or are you selling laptop? Because if you are selling scrap, the rate of tax will be 18%. In our example, in this case. So you have to identify whether the asset is being sold in a working condition. That means you are selling a asset itself. But if it is not in working condition, but you are only getting a salvage value, the rate of tax will be the rate of tax as if you have sold plastic, or as if you have sold metal, or as if you have sold old newspapers, right? Is this clear? So in your fixed asset register, wherever there are additions, there will also be deletions when you are preparing the financial statements. You have to focus a little more on the deletions as well, right? Next is tracking of credit notes issued but not disclosed. If you have issued certain credit notes but you have missed disclosing those credit notes, then ensure that those credit notes are disclosed, because that also comes with a time limit of 30th November. If you don't report it by 30th of November of the next year, then you will not be in a position to claim the tax adjustment relating to those credit notes. I have a separate section completely on this discounts and credit notes because few amendments are proposed, already enacted but not notified, so we'll come back to that a little later. Okay. Another important point which we have to remember is, in case of real estate projects, right, there is something called as occupancy certificate. The year in which you have received the occupancy certificate, there are two things which get triggered. One, it is a time of supply for all the construction you have done for your customer who is a landowner, right? And second, to the extent of unsold units in the project, you are required to discharge the tax under reverse charge mechanism on transfer of development rights, right? This is a topic in itself, but just to make it a little more simple, in a JDA, typical JDA, there are two people, landowner and developer. The landowner has given the land, the developer promises that I will construct apartments on this land which you have given to me. 40% of the constructed area belongs to the landowner, 60% of the developed area goes to the developer. The developer will start selling 60% of his area to the end customer and start collecting GST and discharge to the government. To the extent of 40% which is being given to the landowner, it is as good as developer has constructed 40% of the area for landowner. There is no tax liability on the same when we enter into JDA, right? That liability gets postponed to the date on which occupancy certificate is received. Second, the landowner has given the right to the developer to enter the land which belongs to the landowner. So he has given development rights to the developer. That also the tax does not get triggered on the day you sign the JDA. It gets postponed to the date when you have received the occupancy certificate. So the moment you receive occupancy certificate, there are three things which get triggered. One relates to input tax credit, so I have not covered here. There are two things which you have to understand from an output angle. One, you will have to discharge reverse charge mechanism. The landowner's liability of transfer of development rights gets shifted to the developer, and developer has to discharge tax on the same. The value will be assigned based on the unsold units in the project. Okay. Second, the developer has given construction services to the extent of 40% of the built-up area constructed for the purpose of the landowner. On that also GST is required to be discharged. Clear? Yes, please.
So RCM will be paid on unsold stock, right? After, for a certain portion, one flat is sold. So after completing of year-end and RCM is paid, the customer came and told I don't want, and he reversed the sale transaction. On that sold transaction, what will happen?
So on the day when you received the OC, it was sold.
Yes.
After that, you have unsold it,
Unsold.
which is a very good tax planning, I would say. That's all I would
This
say.
is a real case, but it's not able to find answer.
Yours is real case. What Sanjay is handling is all practical cases, where everything is sold, nothing is unsold that day, and everything is cancelled after that. Correct, no? Yours is also real case only. He is not saying it is not real.
But what is
The wordings are very clear. While it is out of syllabus question for today, but real estate is very close to my heart, so I will never say no to any real estate question. The law is very clear. It very clearly says unsold on the date of OC. So on the date of OC, whether it was sold or unsold,
sold?
that's all. Correct? See, no, but the objective was not this. Objective was never to tax land. I am giving tax on 2/3 by assuming the value of land is 1/3. So when the law is very clear, even if it is not logical, I have to follow it irrespective whether I gain or I lose. On the date of OC, it was sold. What has happened afterwards, I don't have to bother about. Right? Right. Next. Assuming you have a lot of group companies, or in the same pan, you have multiple GST INs because you have registration in Bangalore, you have a registration in Bombay, you have a registration in Chennai, you have a registration in Ahmedabad. Across India, you have registrations. Then there are two things which you have to take care of. One, have you taken an input service distributor registration or not? Route all the credits which are common to everybody in that registration and bifurcate the credits to each of the locations based on the turnover of that location. That is point number one. Point number two, Bangalore being the head office, you might have incurred some cost on behalf of everybody. Let's take an example, right? Couple of examples. Bangalore has appointed statutory auditor because it is the head office. But the statutory audit is for the entire company as a whole. And it will be difficult for me to tell the statutory auditor to raise invoice on each of the branches. So what I will do, as a head office, I will take that expense and then cross-charge it to all the branches on some logical method. Maybe based on sales, maybe based on employees, some rational method I will bifurcate it and send the cost to each of the location. That is called cross-charge. Okay? Example, I have taken SAP license. Right? I have taken 50 licenses in Bangalore, but 2 licenses could be used in Chennai, 5 licenses can be used in Maharashtra. So what I will do is, the total cost incurred by Bangalore divided by the total licenses multiplied by the licenses allocated to each of the locations. I will have to shift that cost which does not belong to me, which has been incurred by Bangalore, but which does not belong to me but belongs to other locations. I will have to move all those costs. So what I have to do as on 31st March is take a list of, if I have a project center, cost center wise accounting or project wise accounting, whatever is sitting in admin cost, corporate cost, head office cost, which is very general in nature, have a look at this this cost and check whether it solely belongs to Bangalore or it belongs to other locations as well. If it belongs to other locations but obeyed by Bangalore, then a portion of that cost will have to be distributed to that location. How? There is no rational mechanism given, only ISD is one of the mechanisms. If you have taken ISD registration, it will go in turnover ratio. If you have not taken ISD registration, then in some rational method, which generally will be turnover only, you will have to distribute that cost to other locations. Again, it comes down to Schedule 1 only. Schedule 1 says transaction between distinct person. What is the meaning of distinct person? Having more than one registration. Transaction between distinct persons will also be treated as a supply even if there is no consideration attached to it. Is this clear? Next. Again, the doubt will be whether ISD is mandatory, not mandatory. Again, those questions will come. But the point is, what was the objective of ISD? The objective of ISD was that if the total transaction does not belong to one registration, it belongs to multiple registrations, that cost has to go to multiple GST INs. Correct? I have not taken ISD registration, but I have ensured that the cost has got transferred to the other location. I have met the objective. Correct? So then there can be no questions of, you have evaded the transaction, you evaded the tax, or credit of Mumbai is sitting here. All those allegations will not come against them. If you are able to demonstrate that in some rational method, we have cross-charged the cost which was commonly incurred for the group to all the other locations. Again, there is a circular which is in our favor. There is circular 199 and then there is circular 210. Okay, very, very interesting circulars. They say if the other person can claim the credit, meaning I am in Bangalore, I have a branch in Chennai. Chennai has only taxable turnover. Even if I don't raise an invoice, 0 rupees is deemed to be the value at which you have supplied the service, which is also acceptable. Right? Those circulars at extreme level we will follow. But otherwise, if you are accumulating the credit in Bangalore but discharging the tax in Chennai, it still makes sense to better to transfer the credit to other locations so that you optimize the cash flow at least. Right? Next is recoveries made from employees or from vendors. If you have made any recoveries from your vendor, from your customer or from your employee, just check whether those are liable to tax or not. So popularly we call it as the credits in the debits. What are the credits in the debits? In an expense account, are there any credits? If there are any credits, like say employee are paying a salary of ₹1,00,000, right? He lost his say ID card. So you have recovered from him ₹1,000 for supply of new ID card, right? That is a credit sitting in his salary. Is it taxable? Or notice pay recovery. You have to pay him 1 lakh salary, but you have recovered from him 75,000 rupees as notice pay recovery. It may not be taxable because we have a circular also now which says notice pay recovery is not taxable. But it will create no harm if we can review all our expenses and see if there are any credits sitting in our expenditure. Is this clear? Likewise, if we are recovering anything from our vendor, from our customers, right, there could be some cost which they had to incur, but because of them we had to incur and we recovered it from them, right? That is a supply which we have given to him. On that also we will have to. Classic example would be, customer has not made the payment to me within 30 days of time limit which was given to him, right? I charged him interest. Section 15 specifically says any interest for delayed payment of consideration will be treated as the part of value of supply and tax is to be discharged on the same. So MSME interest, if somebody has earned, on all of it GST will have to be discharged, right? Next, very, very important, because now MCA, income tax and GST have started talking to each other, right? So all the reports are getting circulated or shared. The data is getting shared by all the 3 departments. So what is happening? You will see a lot of cases where there are TDS credits sitting in your income tax 26AS, which is say around 10 lakh rupees, deducted at 10%. So that means your revenue should have been 1 crore. But in your GST returns, you have shown only 20 lakh rupees or 30 lakh rupees. So because of this, there will be a mismatch between the revenue as per 26 AS versus the revenue reported by you in GSTR1. If there is a reason why there is a difference, because somebody else has created a provision for expenses but you have still not raised the invoice, right? There are reasons, great. But if there are no reasons, then ideally the TDS credit sitting in your 26 AS should match with the supplies reported by you in your GSTR. So create a reconciliation or prepare a reconciliation not just for income tax purposes but also for GST purposes, right? Another interesting notice we've just in couple of cases we have seen relating to this TDS is two kinds of notices. One within GST itself, other outside GST. There was a new section which was introduced, 194R. Now I don't even know the corresponding new section in the Income Tax Act, okay, the new act. So all of us will have to attend those sessions. But the earlier erstwhile 194R which was introduced, which my income tax friends say that it is any benefit given in the course of business to another person. I have to deduct one TDS under 194R that will get reported in his 26 AS, right? So assuming your client is an influencer, right? He has got some benefit which is something has been given to him free of cost, and that other person who has given something free of cost has deducted 194R TDS, right? That means it is a gain arising out of in the course or furtherance of business, and GST is applicable on anything in the course or furtherance of business. Don't you think this will become a taxable activity? So any TDS deducted under 194R, please be very mindful. If there is anything coming in 26 AS, cross check again what does this transaction relate to, and if it is relating to a taxable supply, there are high chances you will have to discharge tax by raising an invoice of the other person. Otherwise GST will go from your own pocket. Second, again on the TDS bit, there are government contracts where whenever I raise an invoice on the government, they are required to deduct TDS under GST, right? So I would have submitted the invoices, they have deducted the TDS and they have reported in my, which is appearing in my GSTR 7, right? Now, if I have raised the invoice and they have deducted TDS, my turnover should be at least that much. Some government organizations would have forgotten to deduct TDS, or there are some private parties with whom I am working with, so there is no TDS. But at least that much should be my turnover. There have been notices which have been issued where there is a huge gap between what was reported in GST TDS versus what has been reported as outward supply in GSTR 1. One of the reasons for that in one of the client's cases which we found out was, as per the tender, I was supposed to get 10% of the tender value, that is contract value, as mobilization advance on the first day itself. I have not supplied any service, I have not supplied any goods, I have not even started work. The day the tender is awarded to me, I give a bank guarantee, they will give me 10% of the total tender value as mobilization advance, and deduct income tax TDS also and GST TDS also on the same. That gets reported in my GSTR 7, and because of that there will be a mismatch, right? Well, we can always argue, and there are case laws both sides whether mobilization advance is liable to tax or not. Without getting into that debate of whether mobilization advance is liable to tax or not, it is very important when we are doing year-end activities to match this report of TDS as well with the turnover which has been reported in our GSTR. Yes.
So one question, going back to 194R example that you've given. So it's clear that the person receiving the benefit, he may come under GST. But is there any situation where this RCM applicable on the company giving the purchases or the benefit?
So RCM has a specific list of services on which RCM will be applicable. 194R generally comes into picture when there is a non-monetary benefit which has been given, which is in the nature of gifts. And I think they have clarified also that discounts will not come under because those are monetary in nature. So when there is non-monetary, then the service which is being rendered mostly will not be the list which is there, right? So then RCM will not come into picture, is what I, but I have not come across a situation where the service which is being rendered will be under RCM and a consideration has been given in the form of 194R. I have not come across that. What if I think you give gift to your lawyer and deduct 194R. Maybe then it will be liable to tax under reverse charge mechanism. You give car to your lawyer because you are very happy that he got you a bail in a car, that Porsche car, some accident had happened, no? So maybe your lawyer got you a bail within 2 days. So you gave that car itself free to that guy and gave 194R. Could be RCM possibility will be there. Or I'm just thinking the moment you ask this question, I have engaged a foreign influencer, then everything is import of service itself. And so I am required to pay tax on the reverse charge mechanism. The famous joke in RCB, you know, now in RCB, in IPL there are only 4 overseas players allowed, right? So they are saying that RCB this time is playing with 5 overseas players. So any consideration paid to Virat Kohli will be liable to tax under reverse charge mechanism, right? Small turnover limits you will have to be careful about. If the turnover in the last year or any of the preceding financial year exceeds 5 crores, then there are 2 things which you have to look at. One, e-invoicing becomes mandatory from the current year, which is 1st April 2026. And second, HSN of 4 digit was applicable only if your turnover was less than 5 crores, but the moment you cross 5 crores, then the HSN which you have to report is 6 digit. Of course, for exports and imports it is still 8 digit only, but for domestic transactions you will have to add those 2 more digits when you are reporting this in your invoices. Next, this is going to be one of the most tedious tasks for all of us. Now, I am sure all of us have gone through a lot of department GST audits. The simplest way to conduct GST audit is GSTR 1 not matching with 3B, 2A not matching with 3B, 9C not matching with financial statements, 9 not matching with 9C. 9 and 9C should not match, that's why there is a reconciliation statement of 9C. The heading of 9C itself is reconciliation between financials and 9. It does not have to match, correct? And then the most interesting thing, 2 more interesting things. Exempt supply, you have not given any documentation, so reject. You have reported exempt supply but not reverse trade, so rule 42 reversal. And then the last most important thing, credit notes, no documentation given, so all the credit notes disallowed, correct? Now, there was a circular which was issued on these credit notes also, that the GST portal currently does not have any facility to check whether the other person, I have raised invoice of 1 lakh rupees, I have given a credit note of 20,000 rupees, I am claiming deduction of 20,000 rupees from the government saying, earlier I have paid tax of 1 lakh, I am getting a deduction of 20,000, please reduce my tax liability. GST portal does not have a facility till that IMS of accepting credit note, rejecting credit note came, where the department officials can check whether the other person has also correspondingly reversed the credit on the 20,000 rupees, because otherwise government is giving me a tax deduction but the other person has claimed full input tax credit of the same, right? To ensure, now this is not the law, but to ensure that our clients are safeguarded. In fact, our offices are safeguarded, because a lot of times what happens is we raise an invoice, the client will say don't raise invoice now, raise it after 5 days, raise it after 1 month, or if you are registered under MSME, I cannot accept the invoice, I forgot to account this, please cancel this invoice and re-raise the invoice, correct? All of us have done that. What will happen is we have an invoice, we have a credit note and we have a fresh invoice. The original invoice we have paid tax, the revised invoice we will pay the tax. There is no issue department has with us. Credit note we are claiming deduction of tax. Suddenly there will be a query which will be raised that you have issued credit note, you are claiming deduction. I don't know whether the other person has reversed the GST input credit or not, so I am disallowing this credit note. Or in some cases we have got queries also. Landowner has raised invoice for renting of immobile property. Amazing query which the GST officer has said. In case of renting of immobile property, what can be the reason for issuance of credit note? How can supply be cancelled? Okay, accounting, you have not done good work, so they have renegotiated the fees. Or that month accountant did not go. Renting of immobile property, property is there, his shop is there, why have you issued credit note? I will disallow all the credit notes in case of renting of immobile property. Clear? So what do we do in all these cases? To safeguard ourselves where we have issued credit note, to safeguard our clients wherever they have issued the credit note, it is better to download all the credit notes which have been issued during the year, send it to all the customers and get a declaration from them till you are in good books with your customer, because after 2 years you don't know whether you are in good books with your customer or not. Now itself, when the relationship are good, send all the transactions, get a confirmation from them on their letterhead that they have either not accounted the invoices, so they are not required to reverse the credit, or if they have accounted the invoice and claimed the input tax credit to the extent of credit notes issued which are mentioned in the annexure, the credit has been reversed. This will help at the time of audits. Otherwise, then we are staring at a tax demand directly on whatever has been claimed as credit notes. So two parts, like I said, it's mentioned here also. Whether they have accounted the invoice at all or not. They have not, then they don't have to reverse. If they have accounted and availed the credit, then reverse the proportionate input tax rate, whatever credit note I have issued. Because I might have issued credit note only for 20,000 against the invoice of 1 lakh. Now, introduction of new series of invoice, credit note, debit note, delivery, challan, etc. Every year this question comes. In whatever WhatsApp group we are, everywhere there is one question which will constantly come is, from 1st April, should I reset the invoice series to 1 or not? And there will be two people with two different views. If you look at statutorily, there is no requirement to reset the invoice to 1, 2, 3. It only says maintain separate series. And how many other series you want to maintain, you can maintain. You can have invoices for your South customers saying South Zone SZ001, which you started when GST started. You can still run it at 999, 1000, 2000, 3000, 5000. Nobody is stopping you. You can have a separate series for North India customer NZ001. You can have multiple series, but nowhere the GST law says you have to reset it to 001, 002. If you want, you can do it. If you don't want, but you want to continue, you can still continue. No issues around that at all. Is this clear? But why do we generally do start with a new series? Because we only have a requirement where the client will come and say, you have raised the invoice on 1st April, can you give it to me on 31st of March? Correct? Because of that practical issue where some of the clients might ask for a backdated invoice so that they can account for it for the last year, a lot of companies have a habit of starting the series with 001 in the next financial year. But is there a requirement? There is no requirement. Clear? Very interesting. Okay, of all the boring topics which we are discussing today, one interesting topic is intermediary services. Okay, right when we thought nothing to be done in GST law, everything is going smooth, on 30th March 2026, like a Trump's tweet, we will be thinking tomorrow the markets are going to tank, I will buy everything, he will tweet something, the markets will go up. Right? Like this year, this amendment has come on 30th of March 2026. Now whether it will apply to last year transaction, it will apply to only next year transaction, it will apply only for 2 days. When was it issued? Was it issued at 12 noon? So will it apply from 12 noon onwards or before that? No idea. Right? So now this is again there is a lot of debate which was going around this, saying that Finance Act has passed, but no notification has come to notify whether this amendment has taken place or not. So that means this amendment of intermediary, will come to what is the amendment, is still not applicable at all. Is one thought process. Right? Now the point is, till now majority of the amendments which we have seen are amendment in the CGST Act and the SGST Act. Right? So finance bill goes to Lok Sabha, Rajya Sabha, and then the president signs it. The day president signs it, finance bill becomes Finance Act. But that was not possible in CGST and SGST because the timelines are different, the parties are different, the person who has to vote is different. So you cannot expect that if the finance bill has been passed in Lok Sabha, Rajya Sabha and the president has signed, on the same day Karnataka governor also will sign. So CGST and SGST will be the same. Right? That cannot be expected. So what they would do is, they would keep everything ready in CGST, wait for all the states also to ensure that the amendment is done in the SGST Act, and then on their common WhatsApp group they would decide that this is the day when we will notify the amended Act, and the amended Act CGST and SGST would work together. Here we are talking about IGST, which does not require amendment in the SGST, right? Second, whenever a amendment is effective from a future date, look at all the finance acts, they have said this provision will be enforced from a date to be notified in the future. For this particular provision relating to intermediary, no such comment was made. If nothing is mentioned, then General Clauses Act says the finance bill or the law gets amended the day it is printed in the official gazette. So this was printed on 30th of March 2026, which means the IGST Act to the extent of intermediary gets implemented from 30th March 2026 itself. Now what is this amendment all about? GST is a destination based consumption tax. All of you agree? GST is a destination based consumption tax. If I am consuming something in Karnataka, the revenue should go to Karnataka government only. It will not go to any other state. Correct? Now, if somebody dies and some services are given to that person, which government should get revenue? No government should get revenue because the services have not been consumed in India. That is why we have Schedule 3, which says any services rendered to a deceased person is not liable to tax. See, to that extent in spirit they have implemented GST. That if the destination is not in India, we will not collect the tax at all. Clear? I know it is a very bad joke, but smile a little so I will be interested in the subject. Right, very bad joke, hopeless joke. Right? Okay, right. So now, GST means destination based consumption tax. If destination is outside India, it is export of service, government should not levy tax. But if somebody from outside India is rendering services to a person in India, it is import of service, destination in India, tax is applicable on the same. Right? So when I pay subscription to Chat GPT for answering to my ASMT 10 queries, correct? The destination is India, tax has to be paid. Correct? But if I am a software developer developing Chat GPT for which the IP is being held by a US entity, it is export. No tax is applicable on the same. Right? Section 13 subsection 8 of the IGST Act was a very weird provision which says forget all this destination based consumption tax. In case of intermediary services, the place of supply will be the place where the service provider is located. Everywhere it is service receiver. In case of intermediary services, service provider is located. So now what was happening? Assuming I am an agent in India, right? Finding customers for my foreign principal who is outside India, finding customers for him in India. Ideally it is export transaction because I am receiving money in convertible foreign exchange. Correct? Now, because I am an intermediary basically means agent or a broker, right? So, because I am an intermediary, that means I am a broker or an agent who is working for a foreign principal. It was deemed that the place of supply is where? Place where the service provider is located. I am located in India. Intermediary did not get export benefit, right? Likewise, look at the reverse case. There is Booking.com, right? Booking.com is an agent or an intermediary who will give booking to Leela Palace in Airport Road, Old Airport Road, right? They are an agent outside India. Location of supplier is the, place of supply is the location of supplier. Booking.com is outside India, correct? So there was no tax which was required to be paid by Leela Palace for the commission paid to the agents which were located outside India. Both ways. So one place government was gaining, the other place government was losing, right? Now what happened because of this? Any person, software company cost us 10% in HSR layout, right? They went for refund application and the agreement said, I will help you with the marketing module, I will help you with business promotion module, I will do market survey. Only those words are there because they are developing a software for that. They are not doing any marketing. They go for filing refund application. They would get back demand notice. Refund you are not eligible, you are intermediary, you are required to pay tax because it is not an export, right? To avoid this situation, government realized that intermediary is not doing any good to me, I am losing revenue some places, asking for revenue where it is not required to be asked for. So they omitted this provision. So that means now For intermediary also, the default rule will be place of supply is the location of the recipient. So now even if I am an Indian agent serving a foreign principal, because the service have been received by a person outside India, it will be treated as export of services. Likewise, now Leela Palace paying any commission to a foreign tour operator will have to, not a tour operator, to an agent who helps in booking agent will have to pay tax on the same under reverse charge mechanism. Is this clear? The issue now is, the amendment came on 30th of March 2026. I have done transactions from 1st April 25 to 31st of March 2026. Only because of these 2 days can I say my entire year sales is export or entire year import of service I am required to pay tax. Here we will have to be little vigilant. If possible, break that invoice into 2 parts. Up to 29, the old rule will prevail. From 30th, that is 2 days, the new rule will prevail. Be mindful, when there is a change in rate of tax, Section 14 comes to our rescue. Section 14 has been designed specifically for change in rate of tax. Here there is no change in rate of tax, there is change in place of supply, there is no provision to address this transition issue at all. Clear?
So, one question, Hanish. If the captive in India is providing 100% services to the parent, IT services, mostly that's what we raise the invoice. But if intermediary services is included now, should that be raised as a separate invoice with a separate HSN code? Or can it?
So now you will be providing intermediary services also.
Yeah.
And your agreement is one only?
Agreement, can be modified. So far it wasn't happening, but now they...
Generally, no, intermediary services will be success based. And all your other development of software will be cost plus 10%. Generally, intermediary will always be lower. So if there are 2 agreements, of course then you will have to raise 2 invoices with 2 separate HSN. But both will be treated as export. But within the same agreement which was there on 29th of March, now on 2nd of April you are raising 2 invoices and assigning intermediary service to one and regular service to other. Then the question will be, for so many years what did you do? Right? Then a demand can be created for all the other issues. And should be. It is legally correct also. Correct. So this transition will have to handle it little carefully.
It's better to go for a separate agreement afresh and do it correctly from this. Right? Forget about last year, whatever has happened now.
Were you providing intermediary service or not?
Well, yes.
Then you have to pay tax, that's all. Again, the issue is, what is intermediary itself is a debate. Right? There have been circulars which have been issued, there are case laws. See, who is actually the recipient of service? Amazing case, okay, of service tax. One of the biggest case which I have read, Paul Merchant, full name I forgot, versus Commissioner of Service Tax. What these Paul Merchant would do, they were a Western Union money transfer kind of a guy. Son is sitting in USA, he wants money to be transferred to the parent sitting in India. They are only exchange agents, they will collect dollars, remit INR. The Service Tax Authority said, the beneficiary of these services are sitting in India, pay tax on the same. Because in service tax also the concept of place of supply will decide the charge of tax. Intermediary came in only in 2012. This case is much before that. The beneficiary is the parents who have received money in India, so pay tax. The court said no, the beneficiary is not Indian parents who have received the money. The beneficiary is the son who has sent dollars. He wanted to send the money, that person is the beneficiary, he is outside India, so no need to pay tax. So in intermediary, because there are 3 parties and you are an agent, who is the service provider, who is the service recipient, that itself is a big question. So if you have crossed that bridge and said you fall under intermediary, my advice is pay tax for the past period. Next, we look at, I was talking to you about discounts. Okay. Now section 15 subsection 3, section 15 is designed, 15.1 talks about transaction value, 15.2 talks about additions to the value, section 15.3 talks about deductions from the value. One of the clauses under section 15, section 15.3 talks about discount. It says if anything is on the invoice says 1 lakh minus 10,000 rupees, value is 90,000, GST is payable on 90,000 only. But if the discount is not on the invoice but given after the sale, that is called post-sale discount, the deduction will be allowed only if the discount was agreed at the time or before the supply. Only then. So basically it means if I have to claim a post-sale discount, I will have to inform my customers I have a volume discount scheme where if you buy up to 10 lakh rupees, I will give you 1% discount. If you buy 50 lakh rupees worth of stock from me, I will give you 2% discount. That communication had to happen and I had to prove that that communication happened before the supply took place. Only then post-supply discount was allowed as a deduction from the value for the issuance of credit note. But Section 15(3) was never linked to credit note. It did not require me to issue credit note at all, right? And it did not require the other person to reverse the credit also. To avoid this post-supply discount concept, to cross-reference credit note with discount, and also to ensure that only when the other person reverses the credit, I will get deduction, amendments have been made in Section 15(3). And the references have been drawn to Section 34, which talks about credit note. Now these two amendments have not been notified because these two amendments are required both in CGST as well as SGST. CGST amendments have taken place. The government will wait till all the SGST acts are amended, then the notification will be issued. This amendment is not effective as of now, but for all practical purposes, there are circulars also available through which we can take benefit of this post-supply discount also. There are few queries. Circular 251 answers few of those questions relating to discount because everywhere this discount was becoming an issue. There are three issues which have been clarified by this circular. I will take all these situations one by one. Point number 1, I raised the invoice of 1 lakh rupees. The customer claimed the input tax rate of 1 lakh rupees. Subsequently, instead of giving him a GST credit note, I gave him a financial credit note of 20,000 rupees. So effectively he paid me 80,000 rupees plus full GST on 1 lakh rupees. So he paid me 98,000 rupees. But I had raised invoice of 1 lakh plus 18,000 rupees. Now the officers were questioning that as per Rule 37, you are entitled to credit, the customer is entitled to credit only if he makes the payment of the invoice within 180 days. You have not made payment of 20,000 rupees, so credit to this extent should be disallowed. There was a earlier circular also, again they have repeated under circular 251 saying when a financial credit note is given, it is as good as payment has been made, so full credit should be available to the customer. That is first clarification they have given. Second clarification what they have given is post-sale discount. In case of post-sale discount, so assuming, let's take an example, okay? And this is the example I have given on this stage like 3 times or 4 times, so don't get bored if you have come again and you are listening to that same example. iPhone, which model is now live now? 17. Okay, so iPhone 17 is launched. What will happen? Just one day before or the same day, iPhone 16 price from 1 lakh will come down to 80,000 rupees. Assuming you are a shopkeeper who has iPhone, who has purchased the iPhone at 90,000 rupees. Times of India first page was a property ad. 5th page there is an ad of iPhone now available at 80,000 rupees. You as a dealer has purchased at 90,000. You have to sell it to your customer at 80,000. What will you do? You will go back to the manufacturer and say, what is this? Manufacturer will say, don't worry, I will give you a price support discount. Right? This price support discount I will give. You were supposed to make a 10,000 rupees profit. You sell at 80,000. You have lost 10,000 on the purchase price and 10,000 profit also you have lost. So I will give you a discount of 20,000 rupees. So now your purchase price reduces. You are still selling at 80,000 and your purchase price is 70,000. You are making a 10,000 rupees profit. Right? The issue now is when this discount is given, can this be treated as subsidy given by the manufacturer for sale done by the dealer to the end customer, and so basically the distributor has got consideration from two people, 70,000 from the end customer, 20,000 from the manufacturer. So now should the distributor pay, that is the retailer should pay tax on both the components or he has to pay tax only on the 70,000? Circular 251 comes to our rescue, says if there is a contract between manufacturer and a customer which allows the customer to demand a price lower than the going price, and the manufacturer compensates the retailer for the discount given to the customer, that will be treated as additional consideration received by the retailer. In all other cases, it is a post-supply discount which will not be liable to tax. So let's take an example. Okay, there is Lenovo and there is some IT company, assuming let's take an IT company TCS. TCS has entered into an agreement with Lenovo saying whichever TCS employee shows their ID card to the distributor, they will get 20% discount on Lenovo laptops. Correct? So this is a discount which has been given based on agreement between manufacturer Lenovo and customer TCS employee. Now when Lenovo reimburses this discount to the distributor, in the hands of the distributor or the retailer, this is additional consideration received for a discounted sale, it will be liable to GST. But when, say we go to Girias will always sell at a lesser price in anticipation that if I sell huge volume, I will get huge amount of volume discount, right? There is no agreement between me and LG that I will buy the fridge at a discounted price. I am going to Girias is giving me a good price, or Devi International is giving me a good price, I am just going there and buying, right? But Girias, though I have purchased at 1 lakh rupees, they are able to give it to me at 95 because they know they will get 10,000 post-sale discount. That post-sale discount is a true post-sale discount which will not be liable to tax, is what has been clarified under Circular 251. The third point which has also been clarified here is that any amount which has been paid by the manufacturer to the retailer is not a consideration received by the retailer for rendering services to the manufacturer. This happened in service tax in automobile case. Whatever discounts was being given by to the car distributors, service tax notice was issued saying, why have you received this discount? So the retailer would say, because I was able to achieve huge amount of sales, so they gave me discount. See, that means you are promoting his business. Pay tax on this. Right? Our argument will always be, I am not increasing his sales. I am increasing my sales because my profit is dependent on my sales, not his sales. Right? But that argument would not be accepted at all. Luckily now the Circular 251 says that whatever the distributor does is for himself. If there is no specific contract which requires the distributor to do something on behalf of the manufacturer, whatever money he gets from the manufacturer is to be treated as discount and not to be treated as additional consideration for receipt of any supply. Clear? Not yet notified. Election of tax liability only when paid reversed by the recipient. We discussed that. Quickly we will go through a few of the easy points. B2B amendments, B2C amendments. One thing which I want to mention here is, recently there is an update in the GST portal which says that if you give any GST invoice of the past period, you will have to give a breakup of the liability and interest will be calculated on the same, right? So that interest gets calculated at the time of filing of GSTR 1 itself. There is a practical issue here. What happens is, at the time when I raised the invoice, customer did not give me his GST number. Correct? What did I do? B2C supply I showed. Correct? In the month of April, I showed it as B2C supply. He comes back and says, was make it GST invoice in the month of May. So what I will do, in the month of May, I will reduce B2C supply to the extent of this invoice, right, and upload this as a new invoice so that my GSTR1 is totally same, but headwise B2B and B2C undergoes a difference. Correct? Who told us this? Nobody told us. By experience we have been doing this. Correct? Now imagine what we are doing, this practice, right, which we will have to do. There is no solution or bypassing this. Now I have already paid the tax on that invoice in April. I am merely reporting that B2C as B2B. System will understand that April invoice is being reported in May. It will calculate interest and you will have to pay that interest.
But it is editable, sir.
Sorry?
It is editable.
What is editable? You have not uploaded that invoice in April at all. Correct? It is only B2C. B2C is in total, not invoice level.
GSTR 3, current month I can edit the taxable value and then.
You want to next year, next month, no.
Next month only, sir.
Next month, what will you do?
Next month I will disclose the invoice.
Correct.
Previous month.
No, you stop there only. Whatever you do in 3B, now look at it from officer's perspective. April invoice reported in May. You have to pay interest or not?
Already I disclosed that B2C invoice. The tax is paid.
I don't know what is that in B2C because you have not given me invoice level details. You are not required to give me invoice level details.
But can we take it out? I mean now.
Now all of us are doing that workaround which you are doing. Nothing innovative there. Everybody is doing that only. But the point is with this modality coming in, the system will automatically say this all the invoices of May, one invoice of April, last month invoice you are reporting now, please pay interest on the same. That's all.
Is there a chance of issuing notice?
100%, so I don't know what is, not chance, confirmed notice. Correct, no? And this generally happens in hotels. Every time an invoice is given, after that you come back and say, give me a B2B invoice, don't give me a B2C invoice. Change the HSN also, don't give me restaurant service, give me bankway service, give me this service, that's what happens. This is not a composition scheme. If you have to opt or you have to go for a quarterly return, the due dates are gone, so you will not spend time on that. If you are into exports and refunds, you have to file a LUT. Even if you have not filed now, you can file it now because 8-10 days will not make a lot of difference, and then the export question of payment of tax on exports will not come into picture. There are umpteen number of case laws which say LUT is only procedural, because in excise also we had this LUT concept. LUT is only procedural as long as all the conditions have been satisfied. It is still an export only and tax cannot be levied on the same. But what will GST officer do? If you have export, show me if you have LUT. If you don't have, pay tax. Now what will happen if I don't furnish a LUT? I have received the money in convertible foreign exchange. I have supplied services to a person who is outside India. I am in India. GST itself, section 1 of the CGST Act says it applies to whole of India. The service has been rendered to a person outside India. Can there be a tax which can be levied? It cannot be. But to avoid that nuisance value, we have to execute the LUT. Not GST, but update your IE code by 30th of June. When I say update, even if there is no amendment, you will just go to the portal, accept everything, that's all. Otherwise, you will get blacklisted, unnecessary. Right? Then, SEZs, again to avoid the nuisance value, right? Download all the SEZ invoices which you have raised without payment of tax. Go back to your customers, ask them, please get me an endorsement from the SEZ officer. If they have already migrated to an online platform, they will have to upload the invoices on the SEZ online platform online, and the endorsements will also come online. But if that SEZ is still in offline mode, then a physical chapa will be required on the invoice which you have submitted to the customer. And this is applicable for supplies to SEZ without payment of tax, or supplies to SEZ with payment of tax where you are claiming refund. In these two cases, you will have to get the endorsements. Endorsement is nothing but a signature that these goods or services have been received by a SEZ, or in case of goods, it has been admitted in the SEZ. Now, in case of goods or services which are being exported, you have a condition. Another condition is you should receive the money in convertible foreign exchange. At least in case of services, it is mandatory. Unless you don't get the money in convertible foreign exchange, it will not be treated as export of service at all. In case of goods, you don't have to get the money in convertible foreign exchange. But if you have claimed refund and then you do not receive the money in convertible foreign exchange as far as goods is concerned, I will repeat again. Services, the condition itself is export of service means a service where you have received the money in convertible foreign exchange. If you have not received the money in convertible foreign exchange, it is not export of service at all. In case of export of goods, the condition is goods should go outside India to a place outside India. So if you have a shipping bill, if you have an export document where the customs officer has signed that I have seen the goods have been berthed on the, loaded on the ship, right? And the ship has gone, it is sufficient export proof, right? You don't have to receive the money in convertible foreign exchange, right? But now another provision was added. It says, if you have exported the goods and you have filed for refund of unutilized input tax credit, in that case you have to receive the money in convertible foreign exchange. If you don't, to the extent what you have not received, you will have to pay back the refund. Is this clear? Services mandatory condition, goods mandatory only when you file for the refund application. Is this clear? Also, very interesting, this geopolitical situation has led to a lot of situations where in between when there was Russia and Ukraine war, FEMA notification was issued where India was allowed to trade with Russia in INR. During that period, which continues even today, you are not required to receive the money in convertible foreign exchange as far as trade with Russia is concerned. Right? Read those FEMA notification. It says if you get the money in Nostro account, not being a SBU account, but a Vostro account, something it says is general understood. Basically, you can get the money in INR, still it can be treated as export as long as RBI allows this. Right?
But just looking at practical situation that's happening, the conversion when it happens, when the dollar or whatever politics comes, the exchange conversion rates are very pathetic.
Very dynamic.
Right? So some of the customers they say we'll convert, whatever money you want, we'll convert it to rupees and we'll send you the rupees. But the conversion is happening somewhere. If not there, it's happening there. Is that still considered as convertible?
It will still be, officers will not agree, but it is still treated as money received in convertible foreign exchange. In fact, even this, there was a judgment also on PayPal account, money received, because somebody, if he does not have an export account, the money will come to PayPal, PayPal will credit in INR. That will also be treated as export procedure. We will go through a few things relating to ITC. One is if you have claimed the credit or if you have received invoices, but those invoices are not reflecting in your 2B, I don't have to say, you have to follow. If you don't follow, GST officer will follow with you. Correct? Now we have outsourced their 2B work to them, right? Just check whether the credits which you have claimed are eligible credits or not, because section 17.5, based on the Safari judgment, a lot of credits which you would have claimed as far as the construction credits are concerned, you might have to re-evaluate whether you want to claim those credits at all or not. Third, if there is any transaction between related parties or group companies or branches, you will have to raise the invoice and then the other person has to claim the input tax credit of the same. We discussed in outward supply, if there are any scraps or write-off, if say suppose there is a company which is into pharma manufacturing, pharmaceutical company, the goods have got expired, or if they are manufacturing some masala powder for food industry, all these have expiry date, and if you are not able to sell the goods before the expiry date, you have to write off that stock. When you write off the stock, not just the value of the stock is a cost to you, but the associate GST also which you had claimed becomes a cost to you, which will have to be reversed. Right? Then Rule 37A compliance, which also the GST authorities are ensuring that if somebody is not filed 3B, you will straight away get a notice that these parties on whom you have claimed the credit have not filed their 3B, so please reverse the credit. If you have classified during your audit or annual exercise, classified something which was revenue expenditure as capital or capital as revenue, then there can be implication as far as ITC is concerned. Because if you look at again section 17.5, C and D specifically, anything which is capitalized, even though it could be renovation expenses or repair expenses, you will not get the input tax credit. But for some reason, if you have charged it off to P&L account, and that is a correct accounting treatment, if it is a correct accounting treatment, you will still be able to claim the credit. So when you accounted the invoice, you thought you will capitalize. But when you are actually finalizing your records, you think no, it has to be charged off to P&L account. You might have to reassess whether the credit is eligible or not, because the moment you charge it off to P&L account, section 17.5 C and D explanation does not come into picture, and so you will be entitled to credit on those renovation or repair expenses. Rule 42, very important. If you have any exempt supplies, then to the extent of exempt divided by total multiplied by the common credit, you will have to reverse the credit, which you have to do on a monthly basis. If you have reversed more than what you were supposed to, you will have to claim it by 30th September. If you don't claim it by 30th September, that extra credit is permanently gone. if you have you have short reversed the credit, then you will have to pay it by 30th September. There is actually no last date for paying. You can pay. Can they say no, you have not paid on 30th September, so I will not collect it from you? Though Rule 42 says you have to pay it by 30th September, you can pay whenever you want. But from 1st April, the interest meter of 18% starts. Payment to vendor within 180 days. If you have not made the payment to vendor within 180 days, then interest will come into picture. You have to reverse the credit plus the interest, and whenever you pay, you will reclaim the credit. We are talking about occupancy certificate receipt. If you are still under the old scheme, where you are paying tax at the rate of 12%, the moment you have received the occupancy certificate, the proportionate credit of unsold area, you will have to reverse the credit. And going forward also, you will have to take proportionate credit, which means, assuming you have received the occupancy certificate in the current year, which is 25-26, and on the date of occupancy certificate, 80% of the project is sold, 20% is unsold. Now, whatever credits you have claimed from 1/4/2019, why I say 1/4/2019? Because this rule was implemented from 1/4/2019, before that this rule was not there. So from 1/4/2019 to till now, whatever credits you have claimed on that project, multiplied by 80 divided by 100 is the eligible credit for you. The balance amount you will have to reverse. And then going forward also, after OC also, there are some touch-up, boundary wall has not been done properly, some landscaping capital cost is there which are incurring. All that cost also you will be entitled to claim credit to the extent of only 80%, because 20% you are not paying the tax to the government. Yeah? I just pick up only things which are important, others I am just skipping. GTA and hotels, you have to file the declarations for change of scheme by 31st of March. We have missed that bus. Again, real estate, if you are going for that 5% scheme, right, which is the scheme which you have to adopt for all the new projects, ensure that the total procurements made by you during the year for each of the projects, 80% relates to procurements made from the registered persons. Only 20% are allowed to be purchased from the unregistered person. If you have 70-30 ratio, then on the balance 10% shortfall, you are required to pay tax under reverse charge mechanism at the rate of 18%. So ensure that you have maintained that 80-20 ratio. If you are not in a position to maintain any shortfall, you will have to pay tax under reverse charge mechanism. Yeah? That formula for what is the cost itself is very painful. So will borrowing cost be included? Will government dues, whichever the taxes which I pay to BBMP should be included, should not be included? Electricity cost, petrol should be included, should not be included? There was a very nice session which was done by Mr. Rahul R. Gandhi some 6 months back on the same topic. YouTube channel of Bangalore branch will have that, you can have a look at that. Getting ready for tribunal, everybody is getting ready. I have got my suit also stitched. Preparation I don't know, suit is ready. Right? What you have to do is list down all the cases which are there on the GST portal, because hard copy will not have track at all. List down which has to go to tribunal. Unfortunately, there is a circular which has been issued which says you have to tell the department that you are going to go for appeal before the tribunal. How do you tell that? First, make the pre-deposit payment. So at the first appeal stage itself, you have to pay 10% of the tax amount. You have to pay another 10% of the tax as pre-deposit. File a letter with your jurisdictional officer. Please don't invoke recovery proceedings, because I am in the process of filing the appeal before the tribunal the moment the portal allows me to. And the last date as of now is 30th June. The way portal is functioning, I am sure it will get extended. But if you are in the process of preparing the tribunal appeal, if you are in the process of filing the tribunal appeal, start experimenting with the GST portal. Filing of refund application, there is a time limit of 2 years. So every month that 2 years is getting reduced. Just check if for the last 2 years you are eligible to claim any refund, and have you claimed that refund or not. Litigation tracker, keep a note of all the litigations what you had and see whether all the actions have been taken on those or not. So simple. All these are very simple. I am sure all of you are aware of it. That's all I have. Thank you very much for patiently listening. If there are any questions, I will be more than happy to take. Maybe 1 or 2 I will be able to take. There's a QR code, there's a community which we have been running since the time GST was introduced.
And if there are any queries, please feel free to post it on this community, and we'll be more than happy to respond to those queries. Thank you very much, Bangalore Branch. Thanks a lot to all of you for your patient listening. Thanks a lot.
Thank you, sir. Dear members, on behalf of Bangalore Branch and the member present here, I extend our sincere gratitude to C. Hanish sir for delivering such an insightful and enriching session on year-end compliance under GST. Sir, your valuable input and practical insight have truly enhanced our understanding and will greatly benefit all the participants present here.
Good evening, everyone.
Good evening.
So the topic for today, I think we had a fantastic session on GST compliances and reconciliations when we closed the books as on 31st March. To be very honest with you, when I got a call from Kavita discussing, she told me this topic. To be very honest with you, I was thinking immediately, first I said yes, because anybody calling, like from institute, calling you to ask a session, to do a session to the members, I consider it as a very privileged honor and opportunity, and grateful to the institute. So many things come at a time when institute calls me. So first I told yes to Kavita, then immediately only 3 things I could remember. TDS reconciliation, maybe provision entries, depreciation, some few things I could recollect, and immediately I asked Kavita what is the timeline, I mean how many hours is the session. First she told how many hours you want. 3 hours, no, 3 hours definitely, I'm not so sure. Then she told first there is a session on GST and maybe 1.5 hours. I thought okay, 1.5 hours we can manage. So with that introduction, some of the things might be repetitive, and in a sense I don't specialize in GST, so generally I have mentioned. And as chartered accountants, in addition to income tax, see, there are no silos, right? I mean, even if you call yourself a specialist in direct tax practice or company law practice, I don't think any practicing chartered accountant has the luxury of silo. When I say silo, no, I don't want to understand income tax, or I don't want to understand GST. That luxury we never have. We may not be an expert, but we are expected to have at least a 365 degree, or at least a general idea of the implications of other statutory legislations also, when we have to be honest, I mean when we have to discharge our attestation functions. So whatever I could think, which a practicing chartered accountant, somebody who is doing an audit and also stepping into the shoes of an accountant, I'm sure most of you will agree with me that though we call ourselves as a statutory auditor during the course of our audit, of course we have independent audit report and we have our own skepticism, professional skepticism and independent approach. But many a times, we have to step into the shoes of the accountant and understand the practical difficulty, especially considering the complexity with which the statutory laws are being changing. And also, knowing the law is not enough. We need to know the forms. Nowadays, I think to understand the law, first we should know the form. Only by knowing the provision, we can't finish the compliance. So, during the course of this audit, whatever practical challenges we will face, I have tried to bring it into this presentation. I might miss also something. Let me see what I can discuss with you. You are welcome to share your experience. As you know, this is a study circle. Just because I am here doesn't mean that only what I speak should happen. We'll finish the session, and questions, anybody have experience, you are welcome to share it after the presentation. And any questions also we will discuss after the presentation. So, March 31st. Now, unlike earlier times, March 31st really is critical, because the backdated entries, the thing of sitting and finalizing books somewhere in September at the time of tax audit and passing backdated entries as on 31st March, that is impossible, especially with the kind of accounting softwares and the systems and processes which most of the clients follow, and with the GST in place, we can't pass any entries after 31st March. Certain categories of entries, yes, of course possible, maybe we can call audit entries. So March 31st is really a critical date. 31st March closure is as good as next 1st April is the next financial year beginning. So we have generally, if you can recollect, compliances under Companies Act, of course LLP Act and GST, which we had a very good session, and Income Tax Act of course, and also some labor legislations, compliances, all those things we have. And all this, as I told you, cannot be separated from the accounting hygiene. Releasing the books of accounts, corresponding accounting entries also has to be reflected as on 31st March. So 31st March is really a critical date as far as the chartered accountant and of course the accountants are concerned. So books of accounts, so here, yes, we are now Income Tax Act 2025, we are in 26-27 tax year, but we are always, I call Bhutakala, we always live in the past, right? Now 25-26 is the audit which we will be doing. So deliberately I have not brought in the corresponding section under the new Income Tax Act, our existing 1961 Act sections only, wherever is possible I have quoted. So we have books of accounts, just a brush up of whatever we already know. There is nothing new in this slide, so everything I am sure each and every one of you know. So this we are trying to recollect. Section 44A, mandatory maintenance of books of account, Rule 6F. So make sure that all the books of accounts are in place. Definitely it is a part of the accounting software. These are the books and documents which we have to go through at the time of finalizing our audits. Digital records digitally maintained are also, they are also books of accounts. And 7-year retention, though it says 6 year, I always say 7 or at least +1 -1. Nowadays I tell the client at least maintain 10 years books of accounts, because those statutorily not required to, see, we need opening, without opening balance we can't survive, without closing balance, so certain entries we might have to even dig 2-3 years past to understand the event, what has happened. So 10 years books of accounts is a very practical thing which I have thought maybe people have different experience. So retain the books of accounts. So this is, as I told you, everything is not an year-end process. Just I am trying to recollect or maybe like a refreshing the what all happens in the life of an account. From specifically Income Tax 1961, priority areas which I put in, PAN and Aadhaar linkage. I'm sure this is almost 99 or 95% people have done it, but this becomes very critical when we file a TDS return. Of late we had situations where 6A and 20% if the PAN and Aadhaar linkage has not happened, TDS default notices will come and the short deduction notice will come to the deductor. So at that time if you realize that the PAN and Aadhaar is not linked, then up to one cut-off date they gave an amnesty, but this is something you have to be careful. So ensure this. Maybe along with the PAN details, you can ask one question can be included in the checklist of the vendor, whether the linkage has happened. You may not have come across this, and I'm sure 99, as I told you, 99% compliance would have happened, but make sure of this. TDS and TDS compliance, I'm sure all of you are familiar with this. We have 4 quarterly TDS returns. So the 4th quarter return is very, very critical, because that is the time it is always good to have a hygiene of the whole accounts, so the whole year, where there could be situations where the TDS was missed in the respective quarters, or there could be a short deduction and non-deduction, or there could be a reduction in the rate, or there could be a situation where the vendor was expected to give a nil or a lower deduction certificate, and based on previous financial years the same vendor or supplier would have given a lower tax deduction certificate. So what happens, first quarter we told, okay, we are giving, please continue with the same lower rate. Second quarter, third quarter we continue to do that. At the year end, it is a very good practice to make sure that you get the certificate, because the onus is on the deductor. If the assessee is in the default, the deductor will get a notice for lower deduction, and the tax auditor, as a part of the tax audit report, will report it. So make sure you get the certificate which the vendor was supposed to give, and after getting the certificate, make sure that it applies to the respective financial year 25-26 to make sure that you are in compliance. In addition to collection, as far as TDS is concerned, we are familiar, we have to collect it, remit it, then the TDS returns, any challan correction, assessment year was wrong, or there was a carryover of the TDS. All those things, what would have happened in the first 3 quarters, thinking that it will happen in the subsequent quarter, it would have happened. Make sure that is the fourth quarter, is the quarter to repair and correct, rectify all the mistakes what has happened in the previous quarters. Make sure that happens. And due date, as you know, for the last quarter, there is for the month of March, the due date is unlike other months. As for non-government deductors, it is 30th April. Government deductors, they have actually the same, that seventh only holds good. If you see Rule 30, they say, they have peculiar two clauses. They say, without challan means on the same day, with challan means 7th day of the subsequent month. So, for government authorities, those who are handling, this 30th April rule is not applicable. You can recheck Rule 30. Advance tax payments. Yes, we have 4 due dates. Any shortfall in advance tax can be taken care at the year end, so that SSC will not have interest. Next, another critical thing is method of accounting followed by the SSC. Accounting policy. See, practically I will tell you what I have come across. As auditors, very rarely we get the luxury of doing only audit. When I say audit, somebody gives you the full set of financial statements along with significant accounting policies, and you will read the accounting policy. In fact, we are supposed to, in our CA final days, we have learned how to do an audit. If somebody has read Kamal Garg book and all our own study material, how to do audit, we need to know all our assurance standards, now essays, accounting standards, and read the accounting policy of the organization and see whether they have done revenue recognition in compliance with accounting policy, whether they have accounted fixed assets in accordance with the accounting policy. Is there any deviation from the accounting standard? So we are supposed to read accounting policy, we have to read the respective accounting standard, and if the organization has, especially in the case of accounting for fixed assets, if the management has taken any decision which is specific to the organization, we have to understand the accounting policy and see whether they have followed the same thing in the books of accounts. How many of us get this luxury if we are stepping into the shoes of accountant? And many times I remind my students, understand financial statements, attestation is our responsibility. Financial statements is not the responsibility of CA office. But what are we struggling with? This is my experience. What are we struggling with? We are seeing tally first. Luckily, tally to trial balance will come. We don't have to do suspense account. In our, at least in my articleship days, first the tallying trial balance was a victory. Now it is so funny to think first day not tallied, second day to the senior not tallied, not tallied, not tallied. Then third day our victorious tallied, the same trial balance. So I am saying now tally trial balance will come. The thing is, what account they have debited, what account they have credited. So trial balance will come. Now we have to step into that accounting level entries, corrections. Certain entries will wait for us. They think that auditor is only allowed to pass that entry. But we may want to understand Kannada. They think the capitalization, some fixed assets, whether it is capital or revenue, it is auditor only should do. Depreciation you may want to. So I tell my students, see, after you become a chartered accountant, you should never start making financials. That's the way, but it's good to learn. It's good to learn. Even it's a little confidence what I have I'm speaking is because of that experience. I'm so thankful for that, because we get hands-on. Now what I wanted to say is, in the process of getting that balance sheet, which gives us the, okay, now I am ready to sign, we are tired. Then imagine that time is the time your real audit work starts. At least that day you should take a break and next day you open your accounting policy. See what revenue recognition has happened. Whether, especially in the case of manufacturing companies, risk and reward, at what point it is getting transferred. Whether the goods in transit they have accounted correctly. Whether the revenue is recognized in compliance with the accounting policies and in accordance with the method of accounting regularly followed by the SCM. See, unlike companies, partnership firms they can follow either cash basis or accrual basis. So what happens? GST only accrual basis. So there are certain partnership firms, they will account, they have one set of books of accounts. They will account the revenue and expenses on accrual basis because they have to take input credit, they have to collect GST and they have to file the GST return. So throughout the year the books are maintained on accrual basis, but at the end of the year they have taken a stance that actually cash basis, because Modalinda cash basis was being followed. If you have to change from cash basis, earlier the firm was very small. If you have to change from cash basis to accrual basis in accounting, in the tax audit report, you have a work to do. You have to do the profit difference and you have to report. So what happens at the end of the year? The reversal entry is passed, reversing all the liabilities and all the payables and debtors, and books are maintained get a balance sheet in compliance with cash basis of accounting, file your income tax return, and then first April reverse it and continue. So I'm saying all these are year-end adjustments. The accountant completely don't even understand what he's doing. If the accountant is little committed and smart, he might see what we have done in the previous financial years and he will do the entries. So their statutory compliance is irrespective of the method of accounting. Your TDS liability you have to pay within the time GST. There is no luxury of cash basis of accounting. So now the next challenge is, okay, cash basis of accounting has been followed by the SSC, but all the TDS returns have been filed on accrual basis, because as far as TDS is concerned, the TDS liability is payment or bidding whichever is earlier. So how will you make your tax audit table? Your expenses in P&L account, the amount on which the first column is amount on expenses which are liable to attract TDS, then on actual expenses on which TDS has happened. Now what happens? Cash basis reversal, accrual basis TDS, your first column, second column can never be more than the first column. So practical situations. Now what will happen? Tax audit last day 29th or whatever, 30th, 28th, 8 o'clock, portal problem. Then what do, ma'am? So that time we should pray all the gods on us and tell that, okay, till 3 months, 4 months, brain never worked. We were sitting on that problem along with the article. Whether not an. But most effective brain works on 30th September, 7 o'clock. I will always wonder how my brain got that. It is not a complete solution, but at least I got something with which I can file the return. So I'm saying this, it is not and with the kind of notices what we are giving. See, I'm sorry, I may not go slide by slide. I'm sure this presentation will be circulated by you. So as I'm talking, whatever practical things I have come across, I'll share. I hope you don't mind that. So, what I wanted to say, this 30th September or whatever due date thing should not be we should never think that is the only way to live our lives. That is not the only way to live our lives. It can be an aberration or it can be, that cannot be new normal. That is not the way to do it. Then all those things can be, phenomenally we can prevent that and attracting the notices. Again, 30th September, somehow I finish, then imagine the notice comes also, again I have to, notice comes, the client will come to me. Where is independence? SSC's problem, and we have signed the tax audit report. So I am saying all these can be to a great extent prevented if this year-end process is done properly. The same tax audit table, instead of doing 30th September, can be done. At least have a way in which if you can do it on quarterly basis, nothing like that. If you have finished on quarterly basis, on fourth quarter, you can catch up all the mistakes. You don't have to again open the tally and say, oh, this is a professional charges, and slowly the client will tell there is a professional charge which we paid to a non-resident and it is accounted under repairs and maintenance. Now 195 TRC, Form 10F. So I am saying this much complication as far as TDS is concerned. Please catch up with your books of accounts now only. You don't have to do an elaborate GL review. At least take care of the ledger review with whatever tools you have. Make sure that all the statutory compliances and whatever reporting you are going through under Companies Act or whatever GST, even under the Income Tax Act, you make sure that the necessary entries and necessary corrections are done now only. That is why even these classifications, these are the conditions based on which expenses can be claimed. Personal expenses. Now there are certain expenses really, we have to take a decision, foreign travel by the director, whether it is a personal expense or not. What happened? He traveled, he went to Europe, he did lot of client meetings, there are bills, everything, documentation, we have educated the client. But after finishing client meetings, he had some tour also. Now, should we do a proportion of personal expenses in tax audit? What should I do? Should I do a disallowance under section 37? So all these things, so at least major expenses, and open your tax audit report, go through the procedures. I know we had been so many years, but still it is good to keep the tax audit report next to you, go through the questions, and with that, whatever reporting you are, at least that we can do. See, I will do entire, all my clients, I will do GL review next 3 days. It's not going to happen. It's going to be a dream. So with focus, you make sure that what all we are signing. We will be signing under Companies Act, under Income Tax Act, or those who are doing GST, GST, that's a different area. Okay. With what we are signing, at least with that, if you do a hygiene check of the year-end closure, to that extent you can educate the client, and he can also make sure that his books of accounts is well enough complied to pass any statutory scrutinies. And you can see if the client has been repeatedly getting scrutiny notices, open the scrutiny notices and the replies what we have given, and we would have committed certain things, or we would have given some explanations for the expenses, per diem allowances, or any categories of expenses which are unique to the client. We would have given some responses based on which the assessing officer has accepted the argument and given a favorable assessment order. Now make sure that whatever has been committed as a part of our reply to the notice is consistently followed the next financial year also. This is something which you have to sit with us. You have to remember that at least major clients who have likely to attract notices, these are all the work which we have to do as a chartered accountant, as an auditor who wants to advise the client as a part of the year-end closure. This is under income tax, capital and revenue. Again, it's a debatable issue. Basic things, if your client has a good accountant, you would have done. It's assets and basic. The critical issues only will come to us. Really, we have to take a decision, especially in government companies. They will have board meetings. They will have, this is what I told, the uniqueness to the client. On what basis they would have done a huge repairs. There are some clients in their accounting policy, they have specifically written that up to one limit beyond whatever is written, the board would have taken a decision in the minutes saying that this will be written off as repairs. They will have a repairs fund and that will be debit, including where to debit they would have mentioned, especially when you do government company audits. Unless you know the accounting policy, and when we signed the audit report, the accountant wouldn't have done, they wouldn't have debited the expense to the fund. Because already they would have debited the P&L account creating that fund, so any subsequent expenses in the nature of revenue has to be debited to the fund. Capital expenditure cannot be debited to that fund, or reverse. Capital expenditure should be debited to the capital reserve fund. They cannot consider it as fixed asset. So all these unique situations you have to make sure so that the bifurcation into capital expenditure and revenue expenditure is very critical. All these disadvantages, TDS default, cash payments. Do just a quick review of the cash payments instead of sitting and bifurcating the entry. Take a look at it. At least, okay, this financial year, at least in going forward, you can get it corrected. Gratuity provisions, payment of gratuity act compliance, whether they have complied with all the gratuity provisions, where actuarial valuation is applicable under AS 15, make sure that they get the actuarial valuation report. Most of the times, at the time of finalizing the audit report, we get a draft actuarial valuation only. Most of us sign the financial statements seeing a draft actuarial valuation. And we are just relying on, of course, we can rely the work of an expert, and we don't understand. At least I don't understand how that actuarial valuation they do. They have some calculation. But at least basic data, if it is correct, whether the accountant has given the same old data, the same actuary, some mail comes and he is sending the same data without understanding the implications. Now, especially with the new labor code, new provision, the calculation of wages itself is different. Number of employees joined, retired, rate of joining, age limit, all those things are the factors based on which the actuary does a gratuity valuation. Now, make sure that the data given by the accountant, by the company to the actuary is updated data. Because we are certifying the provision. If there is an understatement of provision, those who have done government audits will have a fantastic experience. When we get a C&AT query, how they quantify the impact in the financial statements. Whatever happens, instead of telling, actually if you have not done, that the way they ask questions, whatever observation they have, finally they quantify and they say that to this extent your profit is overstated or understated, or to this extent your asset is overstated or understated, or liability overstated or understated. So, the wrong actuarial valuation, see how far we can see the disclaimer and all, to my mind, that can be a fatal accomplice situation. That there also you have to prove that you have taken adequate measures to make sure that the numbers are correct. So make make sure that all these actuarial valuation reports and all are initiated now and get well in time so that the books of accounts reflect the correct provision. And it has an impact when the company is paying tax under MAT. Unascertained liability and ascertained liability is one of the advantage to MAT computation. So your gratuity valuation report and provision is one of the items which you have to take into account if there is a MAT credit. Because that number we have to key in. Even if you use a software like Winman, if people are using Winman, that MAT computation is applicable, the profit will flow, but the rest addition and reductions we have to key in the numbers. Book depreciation versus actual depreciation, that number we have to key to compute the correct MAT liability. What will be disallowances? Very critical, very important. You have to see the previous year computations to make sure that whatever disallowances has happened this financial year, they could have paid. At the time of disallowances, there would have been a tax planning and discussion saying that to the extent of 10 lakh disallow it gets disallowed, but don't worry, if you pay next financial year, you can claim the credit. Now that discussion happened over tax audit report filed full year. See, by the time we finished tax audit last September or October, finished. Now only another 6 months. There is no another one more year to do it. Only another 6 months, November, December, January, February, March. Within March, they should have paid that. Then only they can claim the credit in this financial year for 25-26. Now you have to make sure that, in fact, now the time is over, but at least, if not this year, next year, let them get the credit. 43 disallowances is very important. MSME interest calculation is very important. All these things you have to do. How to do the reconciliations? This I'm sure all of you are familiar. Short deductions, late deduction, PAN errors, mismatches in grossing up, and TDS notices. Check your traces portal. There could have been a mail response to the previous accountant. Email ID is given, his previous accountant left the organization, especially in big organizations. Notices they would have got by mail, nobody checked, or it would have gone to the director who left the company. They didn't see the notices. Open the traces portal and see the default notices, especially when the companies have due diligence process. Investor is coming and they put another external auditor for seeing a due diligence. Statutory compliances in our head, they have done everything. But they will first open traces portal. Their stupid one notice will be seen. 7,000 rupees only liability. Valuation of 70 crore or 700 crore company is happening. But in due diligence report, item number 4, 7,000 TDS notice. If you round off, that number won't come only. But notice will come, mail will come, open IO 7,000, where to see articles, article left. At the time of signing the tax audit report, only we are constant. Even in the even in assessing, nobody is there. Only we are constant. Yeah, what is the currency? First opening, no working paper, nothing. You feel like telling, I will pay that 7,000. Okay, you pay the 7,000. Now how to correct that notice? You can't call traces man and give, you pay, where to pay, how to pay. Now with the new income tax act, we are going to real have fun with the new challan, old challan, rich challan, you don't know. How many days this old challan will be available, I really don't know. So, TDS traces, I'm talking from my personal experience. I feel like crying. Very small thing. One assessment year stupid mistake happened. Now 2 years over. Where to correct, whom to write. If you go to the TDS officer, he first filed after 2 weeks, he's telling jurisdiction wrong. Every day client is calling. She is waiting. I'm saying things becomes very critical. It is not as it is light as we think. Because some investor is waiting, and because of this due diligence report of 7,000 rupees, the investor thinks that he has done lifetime mistake, as if he has not done any complaints on it. So please check your traces portal. TDS notices beyond 2 years, you have to rectify. And this nil certificates, please be very aware of that. And also one more thing, see, TDS 30% disallowance doesn't mean that is compliance of TDS. Still, the assessee is in default. Please educate your client. TDS disallowance in profit, 30% disallowance, that doesn't mean that you can debit P&L account. 30% disallowance is not a planning. I've seen people doing that. 30% disallowance not that I have carry forward losses, no problem, be happy. TDS 30% disallowance. It's not that. 30% disallowance is one portion of the compliance. Still, assessee under TDS circle, they can get a notice for default. Please get the client. PE declaration. 15 CSEB given in the promise that we will get the PE declaration and tax residency certificate. Last day, looking hotel not work, ma'am, so much pressure because of thanks to the great man sitting there. So much pressure on 15 CSEB certification lasted for 3 weeks. Because every day dollar rate is going down, this man wants to make the payment. Now we are not sure after 29th OSA, by the time 15 CP filed the new year came. Now new form, we don't know new form. So I am saying small things can become really critical which no one can help, only partner will be sitting in the office. Non-PE declaration, the client, the vendor was there forever. The thing is, this year, last year, we have a PE declaration and a TRC for the last financial year. Now, based on the assurance and the belief that money has to go out of the country, we signed 15 CSEB. But as a part of our documentation, we don't have lot of mail phone. We don't have documentation even to prove that we have asked the client. I have come across that situation. Because when the matters become serious, when the senior management people and the stakeholders, not even management, when I said the stakeholders, finally the stakeholder is the signing chartered accountant and the director of the company. When they talk, things become serious. All the 500 phone calls which we did, WhatsApp messages we did, all the WhatsApp messages were in the phone of article. Article left it. How to prove that you did a follow-up for your non-PE declaration? And TRC we have 4 years back. What's that TRC? But we have signed 15 CSEB. We have blessed saying that this is a transaction where the assessee has no business connection in India, and we told that there is no need to do TDS. Now what to do? Disallowance. So be careful. These are 31st May due dates, reconcile your TCS liability, all these reconciliations has to happen. Depreciation, this date of accounting is very critical. Bill date, what is the date in which the books it is accounted? Because as a part of your PCD reporting, you are supposed to mention the date of purchase. See what happens, the accountant will have a logic. Now, just because somebody didn't approve, the management would have planned investing in here. They would have called us, okay, if I buy on 29th September, if I get an invoice dated 29th September, can I get full year depreciation? We told yes. Invoice is 29th September or 28th September. For whatever be the reason, because of the process, internal process, so we would have discussed with the senior person and a purchase manager saying that make sure your GRN process and quality assurance process is completed, and because big companies will have process. Though the goods are delivered, unless they finish the QA process and GRN process, it will not get appear in the books of accounts and gets accounted in the ERP, right? 30th September and 31st March, very critical. You have to alert to the client down the line, including so the discussion happens at the senior chartered accountant and the senior management, but the communication didn't percolate to the person who is actually doing the thing. What happened after all the process? Though the invoice is dated 29th September, in the books of accounts it got, because the process didn't happen. What happened? Accounting happened on next financial year, or rather in October. Depreciation gone. We would have done a tax planning thinking that full year depreciation will come. But if you see, now we have to take a call. Here the tax auditor is expected to take a call. What is the date of the invoice? Now, throughout the year, consistently we have taken the date of accounting in the books of accounts. Because date of put to use is relevant. Only for that one big critical depreciation we will take date of invoice. See what risk we are taking. So, I don't know how far we will be able to correct this, but at least major assets, make sure that 30th September is very critical. It appears so simple, but it is not. It makes a difference. And backdated entries are not allowed in big organizations. It needs approval, multiple approvals. Inventory valuation, another major area. Adjusting closing stock, adjusting profit, work back, refund, all those days are over. Valuation methods, then reporting in tax audit, whether liter, what is the unit, liter, number, or packages, or kilograms, What is the unit in which that particular inventory is to be reported? And what disclaimers? See, certain disclaimers we may have to give, like if especially supermarket and all, we say that because of the enumerable number, it is not possible to give an annexure. Are we going to upload an annexure? Sometimes, many times, we may not be able to fill in the tax audit, the table, whatever is given in the utility. So, we may have to say as per annexure, and then what annexure they will give closing stock certificate putting is they will give a 25 pages document and they will send in WhatsApp. First of all, from WhatsApp, I don't even understand what they have sent. And some half thing will come from there. You have to bring it to a visible format and you have to understand what it is. It is not our subject. We are not technical experts. And disappearing messages on me is gone. An interesting part is the report will not come from our client. He would have given my mobile number to the person who is sending that report from some, they would have given a job. See, we have a practical case I am telling you. Practical pharmaceutical company who are manufacturers but they don't own the factory. They outsource to KPL. So the closing stock certificate comes from KPL because the raw material is delivered to that premises and manufacturing happens there and export happens from there. Finally, the closing stock certificate comes from KPL. Now, some accountant or somebody, some unknown number has sent me 25 pages closing stock certificate report. I would have even deleted it. So I am saying all this critical. And valuation, method of valuation we are committing. Have they really followed that? Physical verification certificate, we have to get a signed certificate. And nowadays, actually I was attending one seminar. He was telling the impact of AI. See, we used to give a disclaimer saying that it is not possible to get a physical verification thing because of the volume or quantity. Now, we can't give that disclaimer with AI, he demonstrated actually. If you give the basic data, the AI will tell, including quantity, everything. It was telling actually what is the valuation of the stock, including quantity, everything. Now, we can't write that old sentence which we were copying for the past 10 years, no. Things have changed. If you give that software, if you run in the ERP, 2 acre go down stock, it will tell in 1 second. Related party disclosures 20,000. Now 269 SS, loans, advance, deposit. These three numbers are that what is it a loan, it is an advance or deposit. Now advance means relating to immovable property. Now, relating to immovable property, we always thought it only advance. Actually, the word is advance or any other sum. Advance or sum otherwise. There is a word called otherwise. Now, sale consideration, whether the 20,000 limit under 269 SS is applicable or 269 ST 2 lakh is applicable. In my view, immovable property transaction for cash limit 20,000 is applicable because that section, that explanation in 1961 Act says that specifies some definition, advance or any other sum. So even sale consideration that rule is applicable. Now we have not applied I am telling this because recently I had an occasion to answer one question. Is it 20,000 or 2 lakh? And things are not easy. They come with answer. They will do, if you tell 2 lakh, he will not stop. He will read, he will give you a screenshot of ChatGPT. So I am saying now there could be a disallowance. TP documentation, another very critical part. Benchmarking, ALP, things would have completely changed. Things would have completely changed. The way the client works, the way the costing is, the pricing is computed. When you find your 3C EV, that time you can't rely on a TP doc. At least that updation is very critical. These are some of the deductions. We already what is the time? Okay. Already crossed. Another 10 minutes is okay? These are the regular reconciliation issues. This was the only thing I remembered when Kavita called me. This for sure. Books versus 26 AS, and what? Now the critical question here is, when you will do this reconciliation? Every day AS is changing. Today it was not there in AS, tomorrow it is there. And feedbacks, very critical. AS, I call it Sudarshana Chakra in my office. That orange thing comes from left side, where you are expected to give feedback. I call Sudarshana Chakra feedback. Now, when you open feedback, again partner has to involve. That drop down is very critical. See, if it is a 12A approved NGO, we have to give income not taxable. Okay, so all your reconciliations, Form 3 disclosures, ICDS adjustments, your ICDS revenue recognition, especially revenue recognition and inventory valuation. If any adjustment is there, we are supposed to report in tax audit. So these are some of the things which it is a summary of what all we do. Bank reconciliation now, more or less it has lost its relevance with all the net banking thing. But there will be some surprises. Maybe some check reversal or some maybe some one unique situation they have issued a check. It is always good to make sure that we have the documentation to prove that this bank reconciliation is correctly done. Very rare nowadays, but still it is one of the audit process. From our audit issue days, we have done it. Nothing wrong in making sure that we are. See, I have to tell you, if you are working with accountants, BRS Saita, BRS Saita. BRS Saita means what? Not identifying the reconciled items. You have to identify the reconciled items and see what happens subsequently, right? Especially stale situations, very rare nowadays. Stale check situations, the reversal has to happen in the books. So, if they have done, just make sure that we see that and it is correct. Then inoperative accounts. In bank reconciliation, inoperative accounts, make sure that either you recommend to close it or is there collect a partial for that also, or closed bank accounts. Get a certificate. They will close actually couldn't have got closed. Make sure that you get a closed certificate from the banker. As auditors, we are expected to write directly mail to the banks and get confirmations. Please do that. It is very important, especially with the sweep account FDs. There is a problem. FD balances, they will not give the sweep account balance. There will be a few, one account will come which you will never understand in life. You can't do BRS of that sweep account. So make sure you make a mail, list out all the accounts and tell that is the one place. Irrespective of what you will get a response and you will get respect. You tell we are the statutory auditors, immediately the banker will respond. They will respond and make sure that all the accounts, sometimes you will have surprises. There will be an account maintained by the entity and it will never find place in the books of accounts. Because to the accountant, when he created, especially when there is a split, every year they are creating new books of accounts, communication account close there. And he never creates that account only. And when we write mail to the banker, he will list out one account number, which we never find a place in the books of account. And it will have a bank charge. And we have signed a balance sheet with not reporting that bank balance only. So please write mail directly to the bank. Balance confirmations, major creditors, these are all the regular audit process. Book depreciation, outstanding expenses, up to all the expenses. Make sure that here one thing I wanted to say, what method the assessee follows consistently, make sure that it is being followed. Because some of the companies have a policy of cut-off date. They say that any 25th is the book closure because they will have internal reports to upload. First week of April, and most of the companies they will get that 1st or 2nd or 3rd or 4th April you have to upload that MIS report and many decisions are taken, especially when you are working with group companies. So the accountant here doesn't get time to close the day. He can't wait till 31st March for this input credit. 2 billion bill barbeku. He will keep waiting until 31st March. He can't do that. So cut-off date, if they have a policy of cut-off date, make sure that 25th or whatever date cut-off is being followed, and any expenses are, what they do is they will make a provision entry based on estimate. Especially those companies where they have a very serious process on cut-off. First week of April they have to freeze means make sure that they follow the process because input credit cannot be the criteria. So GST versus books anyway Hanish has handled. This is the same thing I think already. Inter-branch, mirror entries. Mirror entry is very very important, especially nowadays we are seeing that software they use, any mistakes they have to pass contra entry, reverse entry. If you open that mirror head office control account will have some 250 entries, out of that 150 entries will be contra entries. Because whatever mistakes they pass, they have to reverse, they can't delete the entry. So any mistake, you have to reverse it. Now when you check the mirror entry, that 150 entries you will not find in the mirror because this is this man's problem. Now if you upload in Claude or any AI tool, it will not give you answer because formula error it will tell. Some paisa won't be there. I mean, mirror matching, get the confirmations. And understand what all categories of entries pass in both the books. Beyond books, Companies Act, make sure all the board meeting minutes are read. Any actions to be taken is reflected in the books of accounts. Then your ROC filings, secretarial audit, all those. Just make sure that the company secretary records are updated and any actions which has an impact on books of accounts is taken care as on 31st March. GST compliance, we had a very good session on that. Labor laws, silent killer, high court bill, means PT. Whether all the PT, that 2500 PT after some 10 years you get notice with the interest penalty, all those things. Make sure that all those things are taken care. That ESA payable, PF payable, your disallowances, it's all depend on that challan payment, books reconciliation, whatever method you follow in your office, make sure it is done. Anything to be done that particularly disallowances, educate the client, make sure that it is paid within the due date. Compliance with other applicable labor statutes, which is very unique to your organizations, make sure that all the compliances are done. So your year-end calendar, complete book closure, accrual, reconciliations, whatever I spoke only, it's like a summary. Deadlines, due dates, what is the whether the company has a as per the articles of association whether they have power to issue short notice for their financial statement signature, because for us UD is very critical. So especially old Companies Act companies, those who have not amended article, they really had 21 days notice. So now, I mean, with the new Companies Act, short notice is possible or not, be aware of that date, because we can't assign where UD is very critical. Draft financial statements, if you can get nothing like that. Address discrepancy. Last after signing 4 sets of financials, sorry, address there, full resetting. Small things but makes very important. Especially that registered office address, not-for-profit organizations, it is very critical. There is a separate question only on that, saying that is there any change in the office and where the books of accounts are maintained. We are certifying as a part of the 10-day audit. Very important. Though appears very mild, but it is very important. We should not be signing some address from where the company has shifted some long back. Be very sure of that. Review AIs very carefully. Very most critical transactions, some of them you may not find an entry in the books of accounts, especially outward foreign remittances and all. They may not happen. It may not find an entry in the books of accounts, but it may be critical, or we should know the implications under other statutes like FEMA, or any violation has happened, we should see. So please see AIS very carefully. It is not the job of only the article. AIS reconciliation is not the job of the article. Partner has to see the AIS. We have to be very sure of, especially those transactions which will not be reconciled. TDS, income and all reconciliation will happen at our team level, but those transactions which at least not going through the reconciliation process, make sure pay attention to those transactions. The client may not be aware. See, I recently had an experience where one person transferred, I think some number, for discussion I am saying, he transferred I think 60 lakhs. HSBC bank had mentioned 10 extra 60 crore. In a 60 crore is coming. I got shocked and I asked him, what is this fantastic transaction happened? Then we found out that 10 was a mistake from HSBC and we escalated. So I am saying, please pay attention to AIS. Proactive planning is already I spoke to you. And I have one more slide where I have just tried to capture the same thing like a summary where this will be shared to you. Everything, whatever I could think, I don't know, to make it. So here I have tried to capture everything, whatever I could think. This also will be shared to you. Whatever I spoke only, nothing extra. It's like a summary, like a catch-up. Maybe you can put it as a display in office. That's all from me. Anybody wants to share anything? Any questions? If you have, you can ask me. If I know, I can help you. Otherwise, I have only so much. Thank you so much for Institute for giving me this really great opportunity. It was really helpful. I was just thanking the Institute for giving speaking opportunity. I take speaking assignments only with the interest of, I call it as, I was telling Kavita, not avoiding band-aid reading. What is band-aid reading? When problem comes, we will read it. Instead, we are accountable to the people who are sitting in front of us. Read with more focus. And so thank you, really thank you for the Bangalore branch for giving the opportunity, and thank you so much for the people listening to me, though I think I have crossed the time. Thank you so much. Wishing you all a very happy audit season and tax season. With the new income tax act, we are going to have very, I got an opportunity to take 1 or 2 sessions on the new income tax act. See, my feedback is, as I was telling, we don't have to be, it's not a demon. And thanks to the institute, any law under the sun we are capable to read. We can read. Ethiopia Income Tax Act also we can read. Okay. So it is only a question of getting familiar with the new sections and the tables. They have got rid of many things, they have moved to tables, especially TDS compliance, they have moved into tables, just getting familiar with the things, and lots of materials are available comparing things. So wishing you all a happy audit season, tax season. Thank you so much. Keep screenshots and documentation for escalation, sir. Make sure that if escalations it gets corrected, and keep screenshots, and even at the time of closure, if it warrants bringing attention to the statutory authorities, if it is in the nature of transaction which finds a place in your tax audit report, you can attach along with annexure, along with when we attach the financial statements with tax audit report. Make sure you bring attention to this and say that this has been escalated, it is pending for correction. That's all the chance I have taken.
So, but have you seen any such situations where those screenshots or etc. help during any assessment or anything?
Yeah, it may not be an easy process, but yes, it helps. It helps.
Okay.
Maybe, see what happens if you really have a spooky asking for that question. You may have to give a reply saying that this is not corrected. This was from a third party correction, it was warranted. We may have to seek transfer to the jurisdiction assessing officer and explain to the assessing officer.
Okay, and the next question related to this is that there are situations where we have escalated within the income tax portal, but then eventually
No,
the correction
income tax
didn't
portal
happen.
won't help. That's why I told you you have to seek a transfer to the jurisdiction assessing officer.
Yeah.
In case the transfer doesn't happen, also we have to go to the officer and tell that, see, this is the problem for which I am facing. Or you can ask for a video conferencing, sir. In the baseless assessment, you can ask for a video conferencing and explain the situation.
Yeah, but but just as a question, let's say at the very start itself, let's not do the assessment, so let's say in the AIS itself I found out something wrong. So
So feedback you
feedback.
get.
But has the feedback
Deny
correction?
the information.
Okay, denied.
Yeah.
But then corrections with the AIS will not happen with the feedback. That's my experience at least.
See, one experience which I have had was on a HRA, sir. It was an individual case where the tenant was claiming an HRA and though the house was vacated, the tenant kept on claiming HRA. Where my client was a landlord, there was no rental income coming, so we gave a feedback and there one box opens. I think if you choose others, deny, but there you can write saying that what's the briefly you can write. Yeah.
Thank you. Thank you, sir.
Challan collections, it is a lot of problem.
Land correction is a challenge.
Yeah.
Yeah. But it happens, sir.
Happens.
Yeah,
See,
it,
1.5 year
I
I am following up since 1.5 year. They are not.
Yeah, it happens. See, I had a practical case where the individual that formed 26 QB, or rather not 26 QB, I think 194 MTDS, 26 QB. There was a problem with the PAN number and
No, everything is correct.
Yeah.
Minor hit is wrong. It has to go to advanced tax. It went to some other minor hit.
follow-up is like we have to go to that HMP Bhavan Institute. Your case means you have to catch, escalate to the next person. It is a time-consuming task.
Advanced tax. Not a tedious.
It happens, sir. I mean,
It will happen, but 1.5 year follow-up is they are not.
child protection they will do. One or two cases, I mean, my practical experience it happens, but it's not easy. It will take time. It may not happen with the junior level follow-up. You may have to go maybe to escalate, try to meet the senior committee, I mean, the DCA level. or
Commissioner level.
something. Yeah.
But they are asking the information or letter from the other day.
Yeah, all those
PAN
things
number
you
is
see,
mistaken.
and especially in TDS, another challenge is it might go to another jurisdiction. That is another problem. It has nothing to do with the address of the buyer or seller. The TDS jurisdiction of it will be in some Davanagere or some other place. That is another challenge. TDS is a problem. It will get rectified, but very difficult. Not an easy task. And you have to be at it. Yeah. Thank you.
DMMS, on behalf of Bangalore branch and the member present here, I extend our sincere and heartfelt gratitude to CA Rani Madam for delivering such an insightful and enriching session on year-end compliance and Income Tax Act. Ma'am, your session was extremely well structured and highly informative. The clarity with which you explained the provisions with a practical example and the real life insights made as the subject both engaging and easy to understand. Your emphasis on the compliance requirements, common pitfall and practical challenges faced during the year-end procedure has immense value to all of us. We truly appreciate your time, efforts and dedication you have shown to share your expertise with us. Members,